Hey, welcome into the show. This is Everything Money. I'm Seth. This is Paul. We talk about financials, companies. We analyze stock, real estate, businesses. Today, we're bringing you some information on our 8-pillar analysis of how we look at a company when we're purchasing stocks, mutual funds, ETFs, yada, yada. We want to talk about revenue growth and why it's important. This is our pillar number 3. We talk about PE on the show. We talk about profit growth. We talk about free cash flow. Not to be too confusing, revenue growth. It seems pretty simple concept, but companies do grow in revenue. How does that relate to their profit? Companies are losing revenue. Is their company still valuable? All of this we'll talk about. We'd like to show you 2 companies today. They're drastically different. One that's growing and one that's not. Microsoft versus Blackberry. Both are very popular companies and have been for many, many years. Paul is going to show us the breakdown of what revenue growth is, why it matters, and why it matters to you if you're going to purchase shares of this company and become a shareholder. So Paul, take it away, baby.
Maybe we should change Blackberry from popular to well-known.
I see.
Because, by the way, I loved my Blackberry. Did you ever have a Blackberry?
I never had one, no.
Oh, I loved it. You can mark a text as unread. And until Apple figures out how to do that and does it, I will respect the Blackberry Messenger way more, or Blackberry just text in general way more. So revenue growth. You know, revenue growth sounds very simplistic. We always focus on profit with any sort of company. Whenever you look at anything, what does it make? What does it make? How much does it make? But remember, revenue growth is the driver of everything else, right? You know, in our businesses upstairs, we have 7 or 8 businesses upstairs. I always tell our employees, our managers, all that stuff, guys, focus on revenue growth. If it'll drive the profit. If we have an issue with profit, we'll let you know. But in the meantime, I only want you focusing on revenue growth, because revenue at the end of the day is what's going to drive that bottom line and drive so many more efficiencies and things like that you can get in the company, okay? I love seeing revenue growth. I like seeing consistent revenue growth. Now, does that mean that I'm going to pay whatever it takes to own a company that has revenue growth? Absolutely not. And this is the biggest mistake that a lot of investors make. They'll sit there and say, oh, this company is growing, I'm going to pay a ton of money for it. Then they end up overpaying. The other side, though, is if you see a company that has very stagnant revenue or even declining revenue, most people dismiss it very quickly for those exact reasons, and it might be an opportunity to go in and do more research and see if you can still buy it, and that's what we're going to look at with our Blackberry versus Microsoft model. One of the most amazing things that happened to me, the first time I ever realized, like truly realized the disconnect between value and price, was back in 2011. I remember looking at companies, I started doing my 8 pillars, but on my own, and I found Microsoft. And back then, I was meeting with people who were in the tech business, and they're like, Microsoft's dead. It's going nowhere. I can't believe you're buying it. It was selling for about, at the time, $20, $21 a share. I bought a lot of it. I ended up selling at $55 a share. Now it's at $260, $265. Everybody considers it's an amazing company. And the reason being, the reason I liked it so much, look at this revenue growth. This was consistent. Now this is from 2011 to now. This was consistent, though. It just kept growing and growing and growing. And I was like, man, oh, there's a down year, but growing and growing. And I'm like, how can a company be so dead, yet their revenue was driving 8% a year? I didn't understand that. And this is where you have to use this revenue model to understand if there's a disconnect between reality and perception. The perception of Microsoft was literally the words, this is a dying company, was repeated to me over and over. And they had yet to have a down year in revenue when I looked at it in 2011. And I was like, man, imagine a world in which something's dying and the revenue is going up.
I brought this up too. You go to the mall when we were open, and you'd see the Microsoft store with a couple employees walking around by themselves, and you head over to Apple, and there's literally a line out the door to buy these crazy iPads.
Of course. But then you have to understand the other side of the Microsoft business, which is they own Microsoft Windows, and it's very difficult to switch from Microsoft Windows to something else. It's a very sticky business. They were growing their Microsoft Office. They were doing a lot of other things that I sat there and said, man, this just doesn't make sense. Now, I think, has the Microsoft stores closed yet?
I haven't been to them all in a while.
Nobody really goes to these Microsoft stores. They were just trying to compete. It's basically a photocopy of Apple in their own way. Fine. But Microsoft's business side is so strong that even Apple's not creating their own business software. They still go to Microsoft and say, hey, give us Microsoft Office. So this is a big thing for me. And I look at a company like Microsoft, and I see this revenue growth. In 10 years, it's doubled. For a company this large to double in 10 years, that's a huge number. Does that mean you pay whatever it takes to get them? No. Do I think Microsoft's overpriced now? Ironically, yes. Back in 2011, I was able to buy it for 9 times earnings. Now it's like 35 times earnings. So not only has the profit gone up, the multiples have gone up. But revenue growth is how I believe you can look at a company and say, what is the trajectory? Where are they going? And in an ideal world, you'll find a company that's still growing or stagnant, and everybody else thinks it's dead. So that's the big thing about revenue growth. There's no revenue growth in and of itself is not going to tell you whether you should buy a company or not buy a company. It's one of the tools you use, one of the metrics you use to sit there and say, what is this company doing right now? What have they done? What is the possibility for the future? That's it. But it's super important because at the end of the day, what drives the bottom line in profit is that revenue number. As revenue goes up, think about it logically. If you were to have two companies, and let's say you could buy two companies for $10, same price for both of them. This is the revenue for each one. It would be 1, 2, 3, 4, and the other one is 1, 1, 1, 1. Which one are you going to pay more money for?
The top one for more
Probably,
growth?
because if they're the exact same company, exact same margins, everything, this is going to have 4 times more revenue and probably over 4 times more profit, and this one's going to stay the same. You should be willing to pay more for growth. That's a big fundamental thing in value investing, is factoring in growth into your assumptions. Everybody takes the world of investing and thinks, oh, it's so complicated. Take it simply. Your revenue is basically you at home, how much money you bring in every single year from your job. Your expenses are all the other numbers, but if you know that you're going to make 10 times more money in 20 years than you today, is your net worth going to be higher or lower 20 years from now?
Higher, of course.
No different for a company.
What about a company that's declining in revenue like Blackberry?
Now, Blackberry. So I bring up Blackberry, not because I'm like, oh, look, this is amazing. I look at it and say, okay, but there's still value to the company. So let's go to Blackberry. Now, Blackberry, if everybody remembers, was the most popular phone probably in the 2000s before the iPhone came out, right? Is that correct?
Yeah, of course.
Now, ironically, I want to show the stock chart for Blackberry. About $60 a share back in 2011, and today it's at, what's it at right now, $10? $9 a share, okay? So it's down about 85%. Now let's go look at the revenue. The revenue went from 18 billion down to 900 million.
Oh my gosh.
So it's about 90% down, 95% down. It's a big drop. It just keeps going down and down and down. By the way, it was higher than that in the late 2000s. So I'm looking at this saying, now does that mean that if you could have bought a share for a penny, you shouldn't have bought it? No, of course not. It's still a declining company, but there's still going to be value in some way. And you also want to look at it and say, okay, take people's perception of a revenue declining business and factor that in there. A business that's declining in revenue can still make profit and still give a return to investors. The question is, are you overpaying or underpaying for that? Now, I don't want to get into the net income aspect of things, but a properly declining business that can still generate cash is still okay. But from a long-term perspective, you got to keep that in mind with revenue and say, if this revenue keeps declining, at what point is it just going to go out of business? There's still a value to something potentially if the revenue is going to zero. You have to determine what that is. Now, Blackberry, you saw it. The stock price is down 95% or 90 whatever percent, and stock price is down 85%, and the revenue is down 90, whatever the number is. It's a very large number, but still, it's around today. It's still generating revenue, and they're trying to rebuild their business into other aspects. I actually know somebody who sells a Blackberry, and that's just, hey, listen, they might make a comeback. Who knows what happens, but the revenue is declining big time and it can be scary. The good news for an investor is when everybody else is scared, maybe do a little more research and see what the potential is.
If this kind of analysis speaks to you and resonates with you, obviously we use our 8-pillar analysis. This is one of them to look at these companies. It's a real deep dive into their financials. The charts might seem confusing to some folks, but if you keep with this, trust the process of learning this, I guarantee you over the next few months, you can be a more intelligent investor, and follow our show. We'll help you along. If you ever want to join our Patreon and you feel alone out there maybe in this investing process, click the link below and join our Patreon. It's growing. We started in November. We have over 2,000 members, and it's just incredible. We do a lot of content for our patrons, and so we'd certainly welcome you in if you're interested. So that is our take on revenue growth and why it's important. Make sure you tickle the thumbs up on the way out. Thanks for watching. Love you.